I'm Frank Wolf. I'm the president of Epic, for those of you who may not know me. Uh, it is a pleasure to introduce Tamara Telesko. Tamara is the Director of Wealth Planning, I believe is her title, at TIAA. This must be the 8th or 10th such seminar you've done, because I think we first encountered each other when I myself was doing some planning at TIAA as one of its clients. I can report that no event that we hold at Epic attracts more interest than yours. It's partly, of course, your charm, but it's partly also the topic. As my predecessor used to say, there are only two things that bring all people in Epic together, and that is concern for their health and concern for their money. And with that introduction, I will turn it over to you, Tamara, and welcome back to Columbia virtually.
Well, thank you so much. And thank you all for attending the presentation. I really enjoy being here. As Frank said, I'm a member of the Wealth Planning Strategies Group. I'm an attorney by background. And basically what we do is work with clients within TIAA on a complementary basis, making sure that we can answer any questions regarding estate and income tax planning. And I tend to get other questions that nobody else can answer. So it's a kind of a hodgepodge mix of what I do. Today, I thought, since it's already November, and I can't believe it's November, but since it's already November, I thought I would combine the retirement with year-end tax planning. I think we're all interested in making sure that we're getting the best deductions and paying the least amount of taxes that we possibly can, as long as it, obviously meets with your desires. This is your presentation. So if you have any questions, please just raise your hand. I know we got a few previously, so I'm going to intertwine those with part of the presentation. But please, if I'm not explaining something to your understanding, raise your hand. I'm more than glad to entertain any different questions or re-explain something that wasn't very clearly stated. I just want to remind you that this presentation should not be viewed as legal advice. Obviously, if you're going to change any of your estate documents or embark on any income tax solutions, you should talk to your advisors, whether it's an accountant or an attorney, before doing that. But and I'm going to cover a range of topics because I think it will hopefully educate you as to something you didn't know. If I concentrate on one thing and that's your bailiwick, it really doesn't help you in any way. Before I start the presentation, though, I'm based out of New York City, just so you know. And I wanted to just perhaps educate you or inform you, if you didn't know, that on July 19th of this year, New York enacted a new law. It's called the TOD Deed Law, DEED law. And if anybody's interested, it's section 424 of the New York real estate law. And what this TOD law does is it allows owners of real property located in New York City to designate a beneficiary that will inherit the real property. So what you're basically doing under this law is putting a beneficiary designation on your deed to the property. So, and again, this law went into effect, it's brand new. It went into effect July 19th of this year. So the format for doing this is, there is a TOD form, and there's also a revocation of that form. So in other words, if you put a beneficiary designation on your home and 5 years later, you don't want that individual to receive it, you can revoke it and either leave it, going through probate, or you can put a different TOD on it. So just to backtrack, a TOD means transfer on death. And these are mostly associated with, I would say, bank accounts, brokerage accounts, investment accounts. Any non-retirement asset that you have, you can't put a beneficiary designation on it like you can a retirement account. But what you can do is put a transfer on death. So if you have a Chase account, for example, you can go into your Chase account and say, I want to put a transfer on death. I want to put a TOD on this. And you might name your spouse, you might name your child, whatever. What that does is it avoids probate. A beneficiary designation supersedes your will. So it's a way of avoiding probate on non-retirement assets. So what this new law does is it gives you a TOD form that you will have to have 2 witnesses on. So you'll name your beneficiary on that form. And then what you will do is get 2 witnesses to see your signature and have it notarized. And then you take the form to the county clerk where the property is located, and they will file it with the deed of the property. So it becomes a public document. I don't know whether that's good or bad, but just so you know, it does become a public document. Now, this will not trigger a gift tax. This is not a gift. It's a beneficiary designation. And it will not change the step up in basis that the property will receive when the owner passes away. And that's always a big deal for New York residents, because a lot of you have purchased homes, many years ago, and there's a lot of appreciation. So you don't want to miss that step up in basis. This only applies to real property. At least my understanding is condos and homes would be covered by this. Cooperatives would not. Cooperatives are not considered real property. You own a security interest in the building. You own shares of stock within the building. So those are not real property that you can put under this law, that you could put a beneficiary designation on. This is really not new legislation as a whole, because basically my computer, it says, is about to restart. So I apologize. I'm trying to get it off. But this isn't really new legislation. 29 states, in addition to the District of Columbia, have enacted this legislation. On the East Coast, those include Maine, Virginia, the District of Columbia, but there's many other states, Arizona, California, Montana. So you own property outside of real property outside of New York that you may want to put a TOD on. There are many other states that allow this. So before I begin the presentation, I just didn't know if you had any other comments. Anybody had a question about it? No? Okay, I'm going to try to share my screen, but this restarting is on here, so I apologize.
May I ask a question?
Yeah, sure, you can, anytime.
Could you summarize again what the difference between the will and this TOD is?
When you have assets pass through your estate via your will, when you pass away, if assets go through your will, they go through probate. So what happens is your personal representative or your executor has to present the will to the surrogate's court. And in return, and along with that, they have to give the death certificate and what are called letters testamentary. In return, what happens is your executor will get from the judge what are called letters testamentary, which will allow him or her to distribute the assets according to your will. That's the probate process. Doesn't sound hard, but you're not the only one that died. So what happens is the judge has a stack of these documents and he or she has to go through them. During that period of time, during probate, your assets are frozen.
How long does probate take? How
Pardon
long is
me?
probate? Probate, how long does that take? Probate?
It
3
can take,
days?
in New York, the problem, yeah, it varies by state. In New York, it can take a while because they haven't been re-electing probate judges. So
Mhm.
it can take anywhere from, a month to 6 months. It can, depending on how much there is.
Okay.
When you have a TOD or a beneficiary designation on either your retirement accounts or your bank accounts, it avoids probate. It
Okay.
just automatically goes by operation of law to the beneficiary. So it's a lot quicker. And it's a lot less, probate has an expense associated with it also. Not high, but there is an expense. More importantly, it's the time delay. Because if the market goes down, for example, and you have a stock account, you can't do anything with it. Okay?
Thank you.
Oh, my pleasure. Like I said, I'm not sure why this is showing up. I can't get it off of my screen. But anyway, so what we're going to talk about are different topics, including, and I have here, gift and estate tax planning opportunities, charitable planning, income tax planning, and I'm going to talk about the sunset of a lot of the provisions that we have in effect now, and then planning with retirement accounts. So let's first talk about estate planning. Wish I could get rid of this. Let's put it down here somewhere. So when we talk about gift and estate planning, I think many of you know you can give an annual amount to anyone free of any kind of reporting or gift taxes. And that amount in 2024 is $18,000. A married couple together can give $36,000, obviously. In addition to that, you can make unlimited amounts of payments for tuition and medical expenses, as long as you pay them directly to the provider. So if you have a friend, a niece, someone who goes to school, and you pay Columbia University directly, or any university or schooling directly, that does not count toward the 18,000. So it's 18,000 plus. If you have a niece that needs braces and you pay the orthodontist directly for the braces, it does not count toward the $18,000. Just as an FYI, next year that amount goes up to $19,000. Now, what are things that you can do with this $18,000? You can just give them cash, obviously. Cash is always beneficial. You, if they're a minor, you could create a UTMA account or a minor's gift trust, which would hold that money. So you could put it in a UTMA account, which means that you can still remain in kind of in control of the money until the beneficiary reaches age 18 or 21, whatever the state says. You can establish a Roth IRA for them, which is always a good idea if they have any kind of income. They're more teenagers and they make something working during the summer. You can contribute toward a Roth IRA for them. Or if you want to provide for their education, you can contribute to a 529 plan. What a 529 plan allows you to, it's similar to like an IRA for education. The money defers income tax free, and as long as it's used to pay for education, it comes out income tax free. You don't pay any taxes on it as long as you basically use it for education purposes. What the government allows you to do is superfund these. So you can actually use or fund it up to 5 years worth of annual gifting. Now, if you do that, you can't do gifts for 5 years, but the benefit of doing that is it would be deferring income tax free, you know, a larger amount would be. So a lot of people consider doing that. Also, I just want to go over some estate planning ideas for you. The federal exemption this year is very high, $13,610,000, and it's what's called portable. So if you're married and you leave everything to your surviving spouse, you haven't used your federal exemption. The federal exemption is for gifts, or I should say bequests made to individuals that are not your spouse. You can leave any amount of money to a spouse. So this exemption is portable, which means if you leave everything to the surviving spouse, you haven't used your federal exemption, the surviving spouse gets it. So a married couple basically can pass a little under $28 million, federal estate tax free. Obviously, I think if you're in New York, you know that New York's exemption is not that high. New York's exemption this year is $6,940,000, and it is not portable. So you always have to balance out how to use the New York exemption and not incur New York taxes, because if you go over that $6,940,000, New York actually has a cliff where if you go over 5% of that, you lose the benefit of the whole exemption and you're taxed from $1. For those of you in New Jersey has no estate tax. They do have an inheritance tax. The inheritance tax is really imposed only on distant relatives, not spouses, children, parents. It's more if you get into siblings and nieces, nephews, those friends, those kind of things. And Connecticut has an exemption equal to the federal. So it's $13,610,000 this year. So questions you should be wondering is how and to whom your estate's distributed. You should make sure that your current documents reflect your current wishes as to who is going to inherit it, who's going to be your personal representative or executor. Are they still the individuals that you would like to have in those positions? Do your documents include federal or state planning provisions? And that's where I was going with the New York exemption. You want to have provisions for a credit shelter trust so that you can capture the New York exemption at the first passing if you're a married couple. We went over the amount of the federal exemption. You should coordinate your assets. So beneficiary designations, this goes in line with the question that we just had. You want to make sure that if you're leaving assets, for example, in trust for someone, but your beneficiary designation on a retirement account is just them, so they're receiving it outright. Is that what you want? Do you want them to receive some assets outright and some assets in trust? Or should you be coordinating those assets so that they all flow into the trust as designated in your will? And then last but certainly not least, do you have financial and healthcare powers of attorney? Living wills and healthcare proxies are for your healthcare, and that's where you name someone, if you cannot act on your own, to act on your behalf for your medical. And then the other document says under what conditions they will act. I cannot eat on my own, I cannot breathe on my own, etc. Those are state. So if you move from state to state, you should get those updated because each state has their own. As with powers of attorney for financial matters, those are also state directed. And those are people that you want to designate to act on your behalf if you can act on your own for financial matters, making sure your investments are the way you want, making sure your bills are paid, those kind of issues. So it's two different ones, but you should make sure that those are up to date. I have never heard of any of them being turned down because they were old, but I always recommend that if they're more than 10 years old, just look at them again and make sure that the people you have designated are the ones that you still want to have in place.
Tamara, there are
Yeah.
a couple of questions in the chat that can I interrupt you to ask at this point? One had to do, again, with the question of the TOD. Someone asked whether co-ops might, whether there would be is it likely that there would be a change in the rules with respect to co-ops as with condos and directly owned real estate?
Well, the only thing I can say to that is that this law is under the real estate law. So if there was something with co-ops that they wanted to do, they would have to do it under a different section. So this law would not apply, but they could obviously change something within another law.
Second question is, someone asked, how much is the New York State deduction for 529s?
I think it's $5,000. There's a cap of 5,000 for income tax purposes. It's $5,000 per person. Yep.
And then the third question someone asked is, what is the New York State estate tax rate?
It varies. It's at 4%. It starts. I'm sorry. It starts at 4%, and it goes up to 16%. So it's not insignificant. But the 16% is only on estates in excess, the amount in excess of 10 million plus. So it's an incremental. It starts at 4% and goes up to 16.
And someone else just asked, does New Jersey have a TOD law?
No. The only East Coast ones are Virginia, District of Columbia, and Maine.
Thank you.
Yep, no problem. Anything else?
Not yet.
Okay.
I'll keep an eye on it. Yeah.
Okay. So charitable planning. I just want to go over, I get questions, different questions on charitable. So I try to combine them so that at least we're getting a full view of what may affect your charitable gifting. So the first thing that may affect it is your age. So if you're under the age of 70 and a half, things that you should consider giving to charity, obviously cash, that's at any age, but below 70 and a half, cash would be a asset that you could give to charity or should consider giving to charity. Low basis marketable securities, as long as they're held long-term, which means a year or more, are great assets to give because the charity will get, first of all, you'll get the benefit of the fair market value. So if you bought NVIDIA at $10 a share and now it's worth $300 a share, you're going to get an itemized deduction of $300 a share. And you won't have to pay the capital gains that if you just sold it and gave the net proceeds, you would have to pay. So long-term, low basis marketable securities are always a good thing. And other non-retirement assets. Some people give their homes. Some people give boats. I mean, there's a myriad of things that you can give when you're under the age of 70 and a half. And the reason I have 70 and a half there is when you reach age 70 and a half, you can now give QCDs, qualified charitable distributions from your IRAs. They never changed really the age from when required minimum distributions start. So the same items, cash, low basis securities, and other non-retirement assets are good assets to give, but you can also give up to $105,000 of your IRA directly to a charity. The benefit of doing that is that distribution, which would normally be subject to income taxation, is not subject to income taxation. You do not get an income tax deduction for it, but it's not included in your income. And then at death, we add obviously non-qualified deferred compensation. Anything that's subject to income taxation at death is always a good thing to designate in a retirement account beneficiary designation to charity, because again, charities do not pay income taxes, so they're getting the full benefit of it. Your estate's getting the full deduction for it. Retirement plans that have built up income taxes in it, traditional IRAs, for example, are great things if you want to give money to charity following your passing. Naming a charity as a partial or full beneficiary designated on your retirement accounts is always good, because again, the charity is going to get the full amount. And then cash and other non-retirement assets are good to give. Any questions on that? I see 6. Is there anything else? No, I guess we're good. Is there a question? So designating a beneficiary avoids probate, and the answer is yes. And then note that the federal and likely Connecticut estate tax starting points that is currently 13 million will sunset. That is right. And I have a whole section dealing with that, Eli. Okay. So income tax deductions for charitable gifts. This is all presently what you get. If you donate cash, you can deduct up to 60% of a person's adjusted gross income if it's given to a public charity. And that can include donor advised funds. If you give cash to a private foundation, you can only deduct up to 30% of your adjusted gross income, and that's under today's laws. Short-term capital gain, remember I was talking about long-term, held more than a year. If you would donate securities that are held less than a year, you can only deduct your cost basis, so what you paid for that security, up to 50% of your adjusted gross income if it's a public charity, and only up to 20% of your adjusted gross income if it's a private foundation. Long-term is what we recommended in the previous slide. You do get to deduct up the fair market value up to 30% of your adjusted gross income to a public charity, and up to 20% if it's to a private foundation. So the question I always get is, what should I give, cash or securities, right? Cash or long-term securities. And the quick answer is securities from a tax point of view are more beneficial to you. And this is the reason why. If you give cash, cash is cash. The basis of cash, if you give $100,000, the basis is $100,000. If you're in the 24% tax bracket, which I've assumed here, you'll get a $24,000 deduction. So the net cost to you of that gift is $76,000. So you give $100,000, you get a deduction of 24, net, it cost you $76,000. the alternative, if you give highly appreciated securities. So in this case, you bought any stock. You bought Tesla for $50,000 and it's now worth $100,000 when you donate it and you've held it for more than a year. You have gain in that, embedded gain of $50,000. So if you went and sold it, you would pay 15% taxes or $7,500. You're still going to get that $24,000 of income tax deduction, but you're also going to get the benefit of not having to pay capital gains tax. So net, it costs you less to make a gift of highly appreciated securities versus cash, because again, you got $100,000 deduction. You didn't have to pay capital gains tax of $7,500. You got a income tax deduction of $24,000. So net, it cost you less to do that.
There was one question in the chat. Are universities considered public charities or private foundation?
It depends. It depends on whether the university is a private or a state funded. Private ones would be considered the private institutions, and public ones would be public institutions. Okay. So the other thing I wanted to mention in that 2 slides ago, I mentioned about qualified charitable distributions. Just wanted to go over that in a little bit more detail. Lifetime gifts from an IRA to charity. In 2020, first of all, you have to be 70 and a half, as I mentioned. Total annual qualified charitable distributions cannot exceed $105,000 in 2024. It started at 100 and it goes up with inflation every year. The QCD can be used towards satisfying your RMD. So if you have $100,000 of RMD coming out and you make $100,000 QCD to a university, then basically you netted it out. It's not going to be included in your income and you're not going to be getting a deduction for it. So no charitable income tax deduction is allowed. However, amounts distributed to the charity are excluded from taxable gross income. And you must be made to a qualified charitable organization. Private foundations and donor advised funds are not eligible for receiving QCDs. So what is the benefit of doing, of doing a QCD? Well, think about it. If you have a QCD equal to your RMD, it's not going to be included in your income, and that could have tax ramifications for the surcharges on Medicare Part B and Part D, and also what's going to be taxable from Social Security, because those are based on your modified adjusted gross income or your adjusted gross income. And then the other point that I want to make, even though you can do a qualified charitable distribution at age 70 and a half, because you're not required to take a distribution, you maybe want to think about, does it make sense to do it? Or should I let this money tax defer until I have to take it out? And that's just an FYI.
Tamara, there are several questions in the chat that I think you might want to look at this point, starting with Ronald Mincy. Had a question about charitable giving for people under 70.5 years old.
You mean here during lifetime? You can't do it. You cannot do a QCD if you're under 70 and a half.
Okay.
No, she just answered my question. Thank you.
Okay.
Okay. Yeah, you cannot do one if you're under age 70 and a half. Yeah. And just so you know, and people don't tell individuals how this works. Maybe your accountant, if you've done them, will tell you. It's going to be reported as a distribution on your income tax return. And you or your accountant have to write in that this is a QCD and notify the IRS and subtract it out. So it's not like you're not going to get something from the IRA. You are going to get something, but you have to notify them that you did a QCD and it went directly to the charity.
A couple of people raised a question about the question of private universities and public universities.
You can always give money to a university. That's not an issue. It has to just be a qualified.
Yeah, but a qualified one is a 501c3 question, not a question of whether it's private or public, correct?
Correct. So if I led you in the wrong direction, you can always give money to the university. There's not an issue about that. It's more if it's a private foundation. Yeah.
Okay. And then there's a question, you said the long-term capital gain tax rate is 15%?
Well, it all depends on, this was just an example. It all depends on what your capital gains rate is. And your capital gains rate is based on what your income is.
Right. Okay. Thanks for that clarification.
Yep. Yeah, it can be, it depends on where you are on the screen. This was just an example to show you that doing highly appreciated securities will give you more of a benefit.
Okay. I think that's it. Yeah. Sorry.
No, not at all. That's what everyone's here for. Okay. So basically, income taxes, I just wanted to go over the income taxes for 2020. And now again, this is for 2024. So on the left, we have income taxes, which incorporates what we typically think of as ordinary income, wages, retirement plan distributions. A couple of things that are included in ordinary income are short-term capital gains, ordinary dividends, and gain from non-qualified annuity distributions. Additionally, if you're receiving Social Security benefits, a portion of those benefits will be subject to ordinary income tax also, or could be. In the next column here, you'll see that for those that continue working up to the first $168,800 of your net wages are subject to a Social Security tax. You will also see on the right a Medicare tax. It's a 1.45 on all earned income and an additional 0.9% on all earned income exceeding certain thresholds for high income taxpayers. If we move to the center of the chart, we see long-term capital gains. And I guess this answers the person's question why I used 15. It can be 0 if you have income of a married couple, income of less than 94,000 plus, single person 47. It could be 15, which I thought is where most of us would be. And that's, single taxpayers up to 518,900, married up to 583,750. And if you earn more than those amounts, long-term capital gains rates are at 20%. Securities or other assets that are sold after being held for more than a year are what's going to be subject to capital gains tax, which is, as you can see, lower than ordinary income tax rates. Finally, over here on the right side, there's net investment income tax. So some of you may not be aware of the net investment income tax. So I did a little chart for you. The net investment income tax is a tax on your net investment income. It consists of interest, capital gains, dividends, and income from non-qualified annuities. To the extent your modified adjusted income exceeds either $200,000 or $250,000, one if you're single, one if you're married, you will pay net investment income tax on the lesser of your net investment income or the amount by which your modified adjusted gross income exceeds the stated thresholds. So what's modified adjusted gross income? It's your adjusted gross income, and then you add in certain items like foreign, untaxed foreign income, non-taxable Social Security benefits, tax exempt interest. Those are probably the ones that are most. There's also student loan debt. There's a lot of other ones that get added into it. So I did an example here. In 2024, if this Jane is single and earned income of 175 and investment income of 75, she's going to be subject to a 3.8% tax on $50,000. So it's 175 plus 75, right? Which is 250. And she's single, so 200, 250 minus 200. She's going to be subject to the excess of $50,000 at 3.8%. If she earns more than the 200, and here she earns 225, and she still has the 75, she's going to be subject to 3% on the 75. So I just wanted to go over that. If you have any questions, I see the boxes coming up.
Yeah, there are a couple of, do you see there are boxes? One question came back at, Trevor asked, does a gift to personal charitable foundation work for a distribution out of an IRA?
I don't know what a personal charitable foundation is. I apologize.
I think he might mean
if it's a donor advised fund, it does not.
Donor advised.
If it's a donor advised fund you're referring to, it does not. You cannot do a QCD. Is that what you're talking about? A QCD
Trevor
out
Harris.
of an IRA?
Yeah.
I just don't know the question. I apologize.
Thank you. That's exactly what I was asking. I appreciate it. Thanks.
Okay.
Roger Bagnall asked, the net investment tax is also avoided when one gives appreciated securities, correct?
Correct. This is on what's taxable. If you're giving it to, if you don't recognize the gain, then yes, it's not taxed. Is that your question, Roger?
Yeah, is that if you are subject to that investment income tax, when you give appreciated securities, you avoid the capital, not only the capital gains, but the surcharge.
Correct. Correct.
Yep. Okay.
Yeah, the NIIT, net investment income tax, is on your taxable income. If you're donating it to charity, it's not going to be taxable income.
Tamara, can you see the last question by Ronald Mincy? I can read it,
but I don't making reference to assets held for more or less than a year. Okay. Suppose you written ruled over, I don't know what that means. Suppose you written ruled over an IRA into today.
May I ask the question?
Please, Ronald.
Please do.
Sorry.
Yeah.
Thank you. So in a number of your slides, you make reference to a long-term asset is something that you've held more than a year. So suppose correct. I had an IRA outside of TIAA, and which I've held for more than a year, and I rolled it over into TIAA so that it's been in TIAA for less than a year. Is it considered a short-term asset or not?
Well, an IRA isn't a security. An IRA is always subject to ordinary income tax. So
Okay.
it's two different things.
Okay.
But
Thank
you
you.
can roll over, you can always roll over an IRA into an employer plan if the employer plan allows you with no tax consequences. You can roll it over into another IRA with no tax consequences, as long as it's done as a trustee to trustee transfer.
Okay.
So it's, if you take a distribution from your IRA and then you transfer it, I think there's like a 60-day rule or a 90-day rule. You have to do it within 60 or 90 days. I'm sorry, I'm getting a brain freeze, but you have to do it within, I think it's 60 days, or else you're going to be taxed on it. Is that part of your question, Ronald?
Yes, it is. Thank you.
Okay.
One
Okay.
last question, but Harold Frick, did you see that one, Tamara? I don't quite understand.
Yes. Can charitable contributions be used to lower non-investment?
That should be.
Yeah, I think that's basically Roger's question, right? I think you're asking if I contribute money, maybe Harold, can you just tell me what you're asking? Maybe I
Yeah.
don't understand.
Yeah, so if you're below the age of requiring mandatory distributions and you want to give charitable contributions, not by assets or anything, but cash, is there a way of using that to lower your capital gains tax and your net investment income tax?
Well, if you're below 70 and a half, I think that's the starting point. What you can give is cash, appreciated securities, or anything basically else that you've held for a year or more. You can't do QCDs, and you really can't do retirement accounts as long as you're still working, and it can't be a QCD. So
If you're
go ahead.
if you're not working and you're above 70 and a half, but below 73, so you're not getting you don't need to use required mandatory distributions.
So I think maybe your answer is I'm 70 and a half, but I'm not at required minimum distribution age. Can I still make a QCD? And the answer is yes. Is that your question?
So you could make a contribution such that what you tax on capital gains and net investment income will be lowered, even if it's not coming from.
Yeah, I guess that if that's what you're talking about, what you're going to do is lower your income, so you may not be subject to it. Yes, exactly. Sorry. I think I've been having brain freezes lately. Sorry. Yes, that's definitely true.
Okay, that's all the questions we have at the moment.
Okay, let me get this box down. So under the Tax Cuts and Jobs Act, which is basically what we're under now, so many things change from an income tax point of view. And the point is that I'm trying to make here is, will you even itemize deductions? Do you even have enough of itemized deductions that you're going to get over the standard deduction? So in 2024, the standard deduction is $29,200 if you're married. If you're single, it's $14,600. So unless you have itemized deductions in excess of that amount, you're just going to use the standard deduction. And because the Tax Cuts and Jobs Act eliminated so many itemized deductions that we all used to be able to take, the most recent study that I've seen is less than 10% of all taxpayers itemize now. In fact, it's 9.5%. So chances are you're going to be doing the standard deduction. So if that's the case, and then here's other things just before I go on. For a married couple who are age 65 or older or blind, the standard deduction increases by $1,550 per spouse. A single taxpayer, it increases by $1,900 $150. And if the standard deduction exceeds the itemized deductions, you're going to use the standard deduction. So what deductions do you have now? You have medical expenses in excess of 10% of your adjusted gross income. You have mortgage interest up to $750,000 of acquisition indebtedness. Your SALT deduction, the state and local tax are capped now at $10,000. And your charitable deductions depend on what we just talked about. You know, is it long-term, short-term? What charity are you giving to? So in a typical married couple, right, the charitable the SALT deduction's going to be $10,000 in this case. Mortgage interest was 8, charitable deductions were 4, so their total itemized deductions were 22. And as I mentioned up here, the joint standard deductions 29, they're not going to get the benefit of this charitable deduction. So what can they do? What can you do to perhaps get a benefit from all this charitable donations that you're making? So one way of doing it is to bunch your charitable deductions in 1 year. And you can do that through a donor advised fund where you get the benefit of the charitable deduction in the year you make the gift. So in this case, instead of doing $4,000 a year, this person is taking 5 years of $4,000 and donating it to a donor advised fund. They're going to get the benefit of $20,000 in the year they make that contribution. Plus, they're going to have their SALT deduction and they're going to have their mortgage interest deduction. So in that year, their itemized deductions are greater than $29,400, and they can get some benefit of contributing to charity. And you can do it through, like I said, a donor advised fund. You can bunch deductions. Maybe instead of donating in December, you donate in January of 1 year, and then again in December the same year. So you're bunching up your charitable deductions. So you do get a benefit for all this good that you're doing, donating to charity. So will you be in the same or lower tax bracket in the future? And that may guide you as to whether you postpone lump sum payments of income, you defer comp, and fully fund retirement accounts. If you're over the age of 73 and still working, you defer RMDs if possible, and you increase itemized deductions. You may, on the other hand, want to realize investment losses. If you're going to be in a higher tax bracket in the future, you may want to accelerate bonuses and deferred payouts this year. You may want to do Roth conversions. You may want to consider realizing investment gains, withdrawing assets from after-tax annuities, and maybe just have a more tax-efficient portfolio. So just from a charitable point of view, the only other thing I want to leave you with is there is something called tax loss harvesting. So if you have a gain in one stock and a loss in another, you may want to look and see if you can offset your gains with your losses so that you don't recognize any capital gains in the years that you sell. And the example here, I said, you know, if you buy something at $20 a share for an investment of $2,000, and then the price drops to $10 a share, you have a $1,000 loss. If, on the other hand, you bought 100 shares at 20, spent the same $2,000, and the stock went up to 30, and you had an unrealized gain, you may want to offset those two and not have to pay taxes on them and then go on vacation as a joke. That's a joke. But tax law harvesting will help with your income taxes. Are these other questions here?
Yeah, there's three more of Carolyn Westhoff. But if you do a QCD, these gifts disappear from your income, right? Income tax.
Correct. Correct.
And
They offset up to 105,000.
Don Balsito, so is interest payable on $750,000 mortgage fully deductible regardless of what your interest rate is?
Yes. It used to be $1 million. The Tax Cuts and Jobs Act lowered it to 750. Doesn't matter what the interest rate is.
And then Ellie Noam says, but even if you're taking standard deduction, you can make charitable contribution through QCC
Yes.
if you take RMD so that you have the best of both worlds.
That's exactly right. That's
Up to-
exact. Now you're thinking like an accountant. I like it, Eli. You're thinking like an accountant. So that's the way you kind of maneuver these things. If you realize you're not going to be able to have enough itemized deductions to itemize, maybe you do QCDs in that year, right? Because then maybe you're not going to have it in your income, but it's not, it's not deductible, but it's not included in your income. So that's exactly the thought process that you go through. Yep.
Ronald says we'll be able to get these slides or a chance to noodle on it.
Can you get the slides? I don't know. I'll check.
We're
If you
recording
can,
this
I'll give them to you.
presentation.
I would think
Well,
you
but
could.
we are recording this presentation so that
Yeah, you're
we can
recording it anyway.
make it.
Yeah.
So
Yeah.
through Epic, Ronald, you can get access to it.
So I don't know, Eli kind of beat me to the punch here, but I wanted to explain where you are today so that you know what's on the horizon here. And am I running out of time here?
No, we're all right. We're all right.
Okay, just want to make sure.
You still have
So-
48 of the 54 people here, so they're engaged.
So I just want to make sure I get to this. So what I want to go over is the sunset, which you've probably been hearing quite a bit about. Maybe not so much now after the presidential election, we won't be hearing it, but I want you to understand what's on the horizon here. So basically what happened is back with the Tax Cuts and Jobs Act. Let me just get my notes here. Back with the Tax Cuts and Jobs Act, it was passed through what's called reconciliation. So what that meant is it didn't have to have 2/3 of the Senate pass it. It could pass with a mere majority vote. But when you do reconciliation, it has to be income tax neutral over a 10-year period. And this tax act is not income tax neutral. So what's going to happen is at the end of next year, all these changes to the income tax, estate tax law, all of them, if Congress does nothing, will sunset. And if they sunset, they're going to go back to 2017 rates, increase it with inflation, and you're going to have a whole new set of income tax and estate tax issues. There's other things that it affected, but I'm just going to go over basically the ones that I think are most interesting to us. So if things sunset, what's going to happen? Well, first of all, on the individual income tax brackets, presently the top bracket, we have 7 brackets. The top bracket is at 37%. If all of these provisions sunset, the top bracket, there'll be 6 brackets, and the top bracket will be 39.6%. So basically, the income tax rates are going to shift up for most people. The standard deduction, which was double that we just talked about, is 29 plus 29,400 for a married couple, is basically going to be cut in half. Now, with the Tax Cuts and Jobs Act, it eliminated personal exemptions. If you're at all do your own tax returns now, you know you don't get a benefit anymore for personal exemptions. Those actually would come back. They would be allowed. The state and local SALT deduction that is presently capped at $10,000 would be uncapped, and you would be allowed to deduct all of your state and local taxes. Now, I have to say, under both Harris's and Trump's, what they were talking about during the election, both of them wanted to eliminate this cap. So I think this one is in the works anyway, no matter which one ended up winning the presidency. Cash contributions to charity actually increased under the Tax Cuts and Jobs Act. If you remember, I said cash contributions were deductible up to 60% of your adjusted gross income. If this law sunsets, it would be limited to 50% of your adjusted gross income. Under the Tax Cuts and Jobs Act, you don't really have miscellaneous deductions anymore. If it sunsets, we would be getting back miscellaneous deductions to the extent they exceed 2% of your adjusted gross income. And most near and dear to my heart is the federal exemption. Right now, it's 13,610,000. Just as an FYI, that's scheduled to go up next year to $13,990,000. It would sunset and be basically half of that amount, which most commentators are thinking is going to be around $7 million. Still would be portable. So a married couple with an estate under 14 million would probably still not have to pay any taxes, but that would affect Connecticut, for example, or any state that is tethered to the federal exemption. Connecticut's exemption, as I mentioned, is equal to the federal, 13,610,000. If that sunsets, Connecticut's exemption sunsets to that amount. So, what do you do if it sunsets? Obviously we have a year to think about this, but basically accelerate income this year if you think you're going to be in a higher tax bracket under the sunset provisions or the non-sunset, or if it sunsets, I should say. You accelerate income through Roth conversions, time deductions by bunching charitable contributions, as we talked about. And if possible, and this is, not likely, but if you have the wherewithal, if you make lifetime gifts in excess of where you think the federal exemption is going to be. So if we think it's going to be 7 and you have the wherewithal to make a gift to your beneficiary of $8 million, the IRS has already ruled we will not do a clawback. So if you use the larger exemption, federal exemption, before the sunset happens, you get to keep it. And I see there's some questions here, so.
Well, also, Tamara, there are also the 3 questions I sent you that actually you didn't get to. Remember?
Yes, I do have 3 questions. Do you want me to go over those now, or?
Yeah, unless there's some other question that someone has. I think there are none in the chat.
Okay, let me go over the questions that we have. Get this out of here.
I will recommend
Someone wanted to know about getting a refund on Medicare premiums.
Yeah.
All you have to do is contact the Social Security Administration, because they're the ones that handle Medicare premium payments. And if you believe you overpaid it, you can reach out to them, file a claim for a refund, which will usually be automatically processed if the overpayment is identified by the Social Security system. And if it's a complex situation, you can always just contact your local, but there is a process for getting a refund.
Then there were two other questions. Yeah.
The two other questions were, I'm a co-signer on my two children's mortgages. And in general, I think what the question is, I want to pay off one, and then I want to, I guess, give money to the other child as a partial payment. And then what, with regard to estate planning and intergenerational gifts, are there any tax consequences either for me? It's all going to, almost every question is, it depends. On this one, it depends if it's over $18,000, 36 if you're married, then paying off a mortgage is a gift. And what you would have to do is file a 709, which is the federal gift tax return. The federal gift tax return is informational only. All you're doing is saying on November 8th, I gave $500,000 to my son, and that's it. And you file it. It's informational because when you pass away, a 706, your estate tax return, will have a line that said, did you make any gifts during your lifetime? Your executor will check yes. What was the amount? 500. And it comes off of the exemption, federal exemption amount at the time of your passing. So it has no money changing hands. It's informational only, unless you exceeded 13,610,000, which I don't think you would if you're helping paying off a mortgage. So it's informational only, but it will decrease the amount of your federal exemption when you pass away. And then there was another question. Oh, before I go to the other question, New York has a 3-year clawback. So if we don't have a gift tax, but we do have a 3-year clawback. So if you made this gift to your son and then you passed away within 3 years, that gift would not come into your estate for federal purposes, but it would come back into your estate for New York estate tax purposes. And then the last one is when I turned my Citibank account into a joint account. Oh, this is one where a lot of people, have a checking account, and for convenience sake, they'll add a nephew, a child, someone on the account so that they can help them pay bills or do things like that. The question here is, Citibank told me that my estate would still need to go through probate. Well, it would depend on whether you have a joint account with your nephew that's joint with rights of survivorship. If it's joint with rights of survivorship, it will avoid probate. If you just added your nephew onto it, so it's more tenants in common, then yes, it's a contribution service. So they look at when a non-spouse is on a joint account, they look at contribution furnished. That's called the contribution furnished test. Who contributed the money to the account? If it was solely you and you just put your nephew's name on it, it's going to be included in your estate and subject to probate. If instead you changed it to joint with rights of survivorship, then you made a gift, and it will not be subject to probate, but it will automatically pass to your nephew. The other part of that was I buy 6-month CDs. If my nephew is down as having a joint account with me, again, if it's joint with rights of survivorship, he will inherit the CDs without probate. So it all depends on how you have it titled. So you can go back to Citibank and say you want to retitle it joint with rights of survivorship. And that way it will avoid probate and your nephew will get the money. Okay.
Great. This has been great, Tamara. Now, there are just a couple of last questions, if we can just take advantage of you. Heidi Rotterdam asks, what to consider when looking for an executor, and what are her duties as a co-executor?
An executor should be somebody that is good at administrative details. Well, executor's job is basically a 9-month job. What they have to do is have a copy of your death certificate. They have to gather up all of your assets and give a listing of those assets to the judge. So you want somebody that is good at organization, somebody that you trust, but good at organization is probably the key for an executor versus a trustee. If you have a trustee in your will, totally different skill set. A trustee is investing your assets. So one is more administrative, the other is more investment oriented, making sure that the assets are going to survive the term of the trust. So in other words, if you create a lifetime trust for your son, you want someone that will manage the accounts for the duration of the trust and make sure that they know, what your son needs, meet with them, go over it. Administrative, you're dealing with the courts. It's just basically getting organized, giving the courts what they need, and in return, after you get letters testamentary, distributing the assets, paying any taxes if there's taxes, but then distributing the assets out.
And then she asked, she's a co-executor of someone's will. What are her duties?
Co-executor, they share duties. So it's the same. They both have the same duties. It's just they can share them. So one person isn't doing all of the grunt work. One person may be dealing with the court while the other is dealing and calling up all the, brokerage accounts, getting, the insurance policy, contacting them. So they both have the same responsibilities, but they're probably, sharing them rather than one person doing it.
All right. Finally, Ellie went back to your example about the nephew getting the CD and the account. And he said, in your example, does the nephew get a stepped up basis?
Well, it will depend if the asset goes through. One thing I didn't mention in New York actually has something called a for convenience account. So if you really don't want the nephew to get the money, but you want him to help with paying bills, you can go to Citibank and say, I want a for convenience account. And that's what's going to be on the checks, for convenience. And that way it's not a gift. Your nephew can write checks on it, but it's not considered a gift. With a stepped up basis, if it's joint with rights of survivorship, when you pass away, it's automatically going to pass to the nephew. Your half of the account gets a step up in basis, but those are mostly cash. So unless it's securities that you're dealing with, cash is cash and there's no step up.
I meant for securities.
Yeah, for securities, if you add somebody on an account, that's usually split half and half. So when you pass away, half will get a step up in basis. The other will be considered, the half that went to your nephew will be considered a gift, and it does not get a step up in basis.
Okay, the last question was speaking for us all. Trevor Harris said, thanks for this informative presentation. Let's give a virtual round of applause to Tamara.
Oh, you guys are so sweet. There's a whole other section on here, so look at if you want. I'm more than happy to go over it at, whatever works for you guys.